What is going on, you guys? Welcome to the video. Today we're going to be looking at 3 Canadian stocks to buy, going into the month of October. Just want to give a quick shout out to a friend of mine over on the East Coast, another fellow Canadian, Benjamin Levitt, super cool guy. He's got a podcast, got a YouTube channel. I'll link those in the description below. So before we get into the stock picks, let's just keep in mind, guys, that the Canadian market represents something like 2 to 3% of the total global equity market. So as a Canadian, it's great to invest in Canadian stocks. I invest in Canadian stocks. I hold a bunch of them in my portfolio, but we just got to keep in mind, guys, that there are other investment opportunities elsewhere, and I wouldn't strictly limit yourself to only investing in Canadian stocks. So the first stock that we'll be talking about today is Bell Canada, ticker BCE. And Bell Canada, along with the entire telecommunications space here in Canada, I believe are great long-term investments. The top 3 players in the space, so Bell, Rogers, and TELUS, they together own a total of about 90% of the wireless market here in Canada. So extremely dominant. And just comparing these 3 players at the moment, I do believe that Bell is offering the most value. The company pays a 5.8% dividend, so an outstanding dividend payer. And the reason that we're seeing this dividend a little higher than usual is that as we look at the stock price here, guys, it is down about 15 to 20% off of its December highs. And I do think that this is starting to look like a very attractive entry point. So Bell Canada is the largest communications company here in Canada with roughly 10 million customers across the country. Their business is divided between Bell Wireless, Bell Wireline, and then Bell Media. So they're the parent company of programs like CTV, TSN, BNN, Bloomberg. They're much more than just simply a wireless provider. And why I think that Bell Canada is a good stock to buy is, first of all, the barriers to entry into this telecommunications space are very high, meaning that it's very difficult for a new company to come in and compete with these big 3 providers. We can think about the user bases that they've already established. That's a very difficult thing to do. And what these companies have the ability to do is that when there is a smaller company that's coming up and growing and making a name for themselves, they can just go in and acquire them or buy them out. A great example of this is that Bell Canada now owns providers like Lucky Mobile, Virgin Mobile, and MTS, so Manitoba Telecom Services. And going forward, what should continue to be huge for the company is that they continue to emphasize the rollout of their new fiber network, right? So fiber TV, fiber internet, fiber to the home, I believe they're calling it. This is just the newest internet with blazing fast speeds, as they like to say. They're offering their newest 1.5 gigabyte internet service, which is claiming to be 30% faster than the closest competition. They've already rolled that out to customers in Ontario, and they have plans to do so in Quebec soon if they have not already. To me, this is a very reliable play for the long term. This is a relatively mature company in a mature industry, and with the ability to pull in a 4 or 5+% dividend yield, that to me is just very appealing. The stock currently trades for $52 Canadian. Like I said, pays a 5.76 dividend yield, and Bell Canada is the first stock to buy in October. Moving on to the second stock for this video, all aboard the gains train, choo choo. It's CNR, Canadian National Railway. And the railways are an industry that I very much like to invest in. They're steady and they're very good at generating cash flow. And CNR is kind of the cream of the crop when it comes to this space. So they're one of 2 major railroad companies here in Canada, them and then the CP Rail. And CNR is actually the 2nd largest publicly traded railroad in North America. Now, just comparing the 2 here, CNR trades at a lower PE, a lower price to book, and as well pays a nicer dividend than CP Rail. And it's funny to me to think that how, in 2018, with all these methods of transportation and all the advancements that we've been making as a society, that, railroads still exist and thrive. To me, they're such an old, historic thing, but they really are still, the backbone of our economy in terms of transporting freight. And our economy is still very dependent on these railways, and that's exactly what makes them such a good investment. I mean, CNR has over 20,000 miles of routes. They handle over $250 billion worth of goods, and that's covering not only Canada, but parts of the US as well. They have a very unique 3-coast access system, which spans from the west coast of Canada all the way over to the east coast and then down into the States, so into New Orleans. So just a huge player in transporting freight pretty much all across America. They posted some very positive second quarter earnings across the board. Net income up 27%, earnings per share up 30%, operating income up 7%, revenues up 9%. They're actually buying 60 of GE's locomotives. They're adding 1,000 new hopper cars to their fleet just to keep up with the ongoing demand. This is the highest margin railroad of them all, and assuming the economy stays strong, people need to transfer freight here and there, CNR should benefit and should continue doing very well. The stock currently trades for $114 Canadian, pays a dividend of 1.6%, and CN Rail is the second stock to buy in October. Moving on to the third and final stock for the video, this is one of my favorite dividend payers here in Canada. It's the company Fortis, ticker FTS. And if you're from Canada, you're probably familiar with the company Fortis. You've probably seen or heard those commercials like, if you smell a gas leak, call Fortis. And Fortis is a utility company that delivers gas and electricity across Canada to the US and as well to the Caribbean. And although it is a Canadian company, they do derive about 60% of their earnings or their income from the US. So that in and of itself is a positive in my opinion when you think about the geographical diversification right there. Now, Fortis is a company that has seen some downwards pressure over the past little while. The stock is down about 15%, largely in part, in my opinion, to rising interest rates. And utility stocks are notoriously known for performing poorly when interest rates are rising. They almost tend to move opposite of each other. Excuse me. And the reasoning behind that is that if you're an investor, let's say for example you're an older investor that's seeking some income or some yield, especially during a time where interest rates are low, which we have been experiencing, investors will very commonly resort to dividend paying stocks for that yield. So rather than saying, hey, listen, I can invest in a bond or a fixed income asset and get like a 1 or 2% return, why would I not just invest in a utility stock or a stock like Fortis where I'm generating a 4% yield? And that's completely logical. Now, as interest rates rise and the fixed income returns become more attractive, so let's say a bond now yields 3 or 3.5%, that same investor may say, well, why am I investing in a stock like Fortis and taking on the excess risk of being invested in the stock market when I can just go invest in a bond or fixed income and basically generate that same yield with a much safer investment? So in a rising rate environment, which we're in now, you'll see investors cycling their money out of these dividend paying stocks, these dividend paying industries, and into a safer asset like a bond or like the fixed income market. And in my opinion, that's what we're seeing with, for example, the utility sector, as well as sectors like the consumer staple sectors, just these high yielding equity sectors. Now, all that being said, with the stock down this much, this to me is really, it's a macroeconomic event, all right? This isn't, the stock being down 15% because, Fortis is performing poorly or because, their management screwed up with something. That's not the case, right? This is kind of an industry-wide, like I said, a macroeconomic event. And it's times like these where I think we should be going in, taking advantage of this discount and buying into some of these strong companies like Fortis. They're very well diversified in terms of the companies they own and the places that they operate. There's a reason why they're the leader utility player and growing in North America. They've increased their annual dividend for 44 consecutive years, and they're actually projecting an average dividend growth rate of 6% through 2020. So assuming that they're able to sustain those projections, this could be a very, very reliable dividend growth stock for your portfolio if that's something you're looking for. But the stock trades for $42 Canadian. It pays a 4.02% dividend, and Fortis is the third stock to buy in October. So guys, those are my 3 Canadian stocks to buy going into the month of October. Do you own any of these stocks? What do you think of my stock picks for the month? Feel free to let me know in the comment section below. If you enjoyed the video, feel free to drop a like as well. That really does help support the channel, and I really do appreciate it. And if you're not already subscribed to my channel, I post a video every Monday, so subscribe and hit the bell for notifications. And as always, I thank you for watching, and I'll see you in the next video.